Good afternoon, everyone. Welcome to Stance Capital's 2020 full year and Q4 review. A few words up front about the process. We will present for about 20, maybe 25 minutes at the most. Our commitment is to have this be an event that concludes within 30 minutes for folks that need to move on to other things. However, we will also stick around and ask and answer questions as long as there are questions. And to this point, you can post a question at any point in time in the chat box, and we will, if we happen to notice it and it fits with the narrative, we will answer on the spot. Otherwise, we will take them at the end. So with that as a background, my name is Bill Davis. Joining me on the call today is my partner, Kyle Balkasoon. Together we run Stance Capital, and we are both co-portfolio managers on Stance Equity ESG Large Cap Core. Kyle and I came together because of a belief that it was possible to build portfolios that allowed clients to incorporate sustainable or other types of values into the companies that they own. And I would say that our belief is that if portfolios are constructed properly, this is effectively a free option for investors. One of the things that, Kyle, if you want to advance that slide. One of our beliefs, and we, by the way, began working together in 2013 and launched the strategy at the beginning of 2014. So we now have a 7-year track record in it. But one of the things that we believe is that sustainable investing has become largely inevitable. And there's really a bunch of drivers that I think are creating sort of a cycle that is going to cause this to continue to move in this direction. The first is, up in the upper left of this slide, that the number of global ESG regulations is increasing, and it has been doing so really for about 30 years. And a lot of this is a function of governments around the world and civil society in general becoming increasingly concerned about climate risk. Perhaps in response to that, or perhaps sort of alongside of that, the number of asset owners and managers that have also been concerned about performance risk associated with environmental, social, or governance related issues has grown substantially. This slide is a little out of date because I think it's only through June of 2020, but actually there are now over 3,000 institutional asset owners and managers globally, representing $100 trillion of assets that have signed on to, that are UN Principles of Responsible Investment signatories. And in this, and the number of investors that are signing on and incorporating ESG considerations and criteria is escalating every year. Not surprisingly, if you jump to the lower left, assets moving into the ESG space have grown substantially. For a long time, there wasn't a whole lot of movement. And then in 2019, towards the latter half of 2019, they began to grow. And through 2020, by the way, this slide includes sort of COVID in 2020, and you can see that the pace accelerates. And as a result of that, there are more and more funds being created. These are not just ESG funds, but also funds focused on human rights and other components of ESG are also being created at the same time. So at a very top line, Stance is focused on performance and what we would describe as systematically delivering market-leading performance while at the same time incorporating sustainable values. We don't invest in fossil fuels, tobacco, or weapons. We try and align with the UN Sustainable Development Goals, of which there are, I believe, 17. We have been awarded 5 stars from Morningstar for top decile performance, and we've enjoyed that distinction since we had our 3-year track record, which is the first point in time when it's possible to get a 5-star rating. Kyle, if you want to advance. Okay. As I mentioned at the beginning, we think that if portfolios are built properly, values alignment is essentially a free option. So we focus on 3 things. One is trying to be thoughtful and consistent around how we think about incorporating ethics into portfolios. And I say this because the ESG space, if you're familiar with it, is a little bit of the Wild West, and it's a little bit up to portfolio managers and firms to determine how they define ethical consistency. But one of the things that we've noticed is that there are passive funds and active funds that own lots of fossil fuels and other things that from our standpoint probably shouldn't be in the portfolio, or at least our clients have expressed to us that they're not interested in having it in the portfolio. So what we have built is a framework that is extremely consistent, and at the same time, it is dynamic so that as additional ESG information becomes available, we're able to incorporate it into portfolio construction. Secondly, we are very focused on this concept of delivering value for fees regardless of the macro environment. We are also, we take note of the fact that many ESG strategies in the market today are growth-oriented, technology overweight, and FANG concentrated. And of course, over the last 6 or 7 years, that's probably been a pretty good thing. However, we've actually, I think, found a path towards delivering value for fees that is less dependent on specific segments of the economy, such as technology. And then lastly, I want to make the point that we are unemotional, multi-layered, and have found a way to decouple alpha generation from ESG factors. We think this is important for a variety of reasons, not the least of which is that over time, it's reasonable that clients and investors are going to want more, I guess, ethically specific versions of ESG strategies that might be based on something like human rights or gender equity or faith or frankly anything else. And I think our approach actually lends itself fairly well towards that. And then the final point I want to make is that we believe that risk efficiency is a large source of outperformance. And we're going to walk you through why we think that's the case, and also how that plays out actually, or how it has played out in the last 12 months. So in terms of portfolio construction, I'm going to tackle the ESG piece of this. I'm going to turn it back over to Kyle shortly and have him talk about fundamentals and risk efficiency. But at a high level, the first thing that we do within the portfolio, and I should say that we invest in companies in the S&P 500, so we're dealing with large cap liquid US equities. The first thing we do is we remove weapons, tobacco, fossil fuels. Then we rank every company against industry group peers on up to 21 key performance indicators. And then we impact weight those KPIs based on the industry group. So that's to say that if we're talking about a bank, we're not looking at, NOx, SOx, VOx, and particulate matter. We're not looking at air emissions. In other words, we're looking at things like CEO to average worker compensation and philanthropy practices and diversity of board and management teams and so forth. On the other hand, if we're talking about a materials company, we're probably looking at a whole lot of environmental considerations in addition to the social and governance considerations. And through this process, we whittle the full S&P 500 down to about 200 companies. We then set those companies aside. And in fact, while we're doing that, we're also running a fundamental process. And Kyle, I'll turn it over to you now.
Thank you, Bill. So just to recap, our portfolio construction process kind of has 3 components. The first component is the ESG screen that Bill just covered. The second one is a fundamental factor model. And the goal of this model is to pick names that we think will have a higher probability of outperforming the S&P 500 on both a total return and risk-adjusted basis. So to do this, what we do is we pull in as much what we call fundamental financial data, anything from valuation ratios, growth rates, different ways to compare companies in a peer group, expected growth rates of the future, historical market data, and then we compute some statistics off that. So looking at things like historical risk, different measures of momentum. And we feed that into a proprietary machine learning model and framework that we have that tries to balance between what factors perform best under which conditions and which ones are good short-term dynamics and long-term dynamics. And what this effectively does is it gives us an estimate of which names will outperform. And what we then do is we intersect that with the ESG list and saying, let's give us the names that we like the values of and that we think will generate excess performance for our clients. But one of the problems with having a list of this sort is we need to manage risk. And what I mean by managing risk is allocating the correct weight to each name such that we can reduce our tail risk and maximize diversification. So what we then do is we have an optimization process and model, and it tries to effectively assign the best weights to minimize risk. And the reason why the optimization process is solely focused on risk is we let the returns side, or having to pick the names, happen here. And this side tries to give us that basket with the least amount of risk. This gives us approximately 30 to 65 names. It also knocks out names. So some names may be assigned a weight of 0 if it's purely additive from a risk standpoint. And we have a max weight of 3.5%. Some things I'm going to call out is we're going to assess how good we were at stock picking later on in 2020 and how much value add did our risk process add after too. So let's just keep that in mind. I'm going to go to the next slide, which kind of outlines our process and the cases. You'll see the ESG status in the second column from the left, and if it passed or not, and the fundamental status. So if you think of that going back to our process, and then the optimizer. If I want to call out Apple, for example, they didn't make it in the top half in their peer group because they had a lot of fines which hurt their score. They also didn't pass our fundamental screen due to the model didn't like what they were doing with their free cash flow compared to their peer group. I'm going to jump to CBOE. They passed both our ESG screen. Our model liked their relative free cash flow, but the risk framework said, nope, these guys are just adding risk. Then finally, if we look at Garmin, they passed the ESG. They had good EBIT growth, which was the biggest contribution from a fundamental status, and the optimizer assigned them a non-zero weight. This is our sector exposure as of year end. And what this shows is we were underweight tech compared to the benchmark, overweight healthcare, overweight the consumer. And generally speaking, we are a bit underweight tech. We've been historically at benchmark or over on healthcare, but we have not been a large FANG or GAFAM, depending on Google, Apple, Facebook, Amazon, Microsoft, and we'll cover our exposure to large names later on. I'm going to hand it back to Bill here.
Sure. So I've mentioned a few of these things already, but we're a long-only strategy. We benchmark to the S&P 500 primarily, typically hover around 50 positions. We rebalance quarterly, daily liquid. We have been available through separately managed accounts on Schwab, Fidelity, TD Ameritrade, now Envestnet, now also Natixis and First Affirmative through Model Delivery. It has been announced that our product will be available shortly. And when I say shortly, I mean within a month, likely in an actively managed New York Stock Exchange listed ETF. We can talk more about that a little later on, although really all we can say is that the prospectus has been filed. You can go to the SEC and actually read the prospectus, but we are certainly not marketing the product at this point, just letting you know that that's kind of a future thing. From a performance standpoint, we're going to cover this actually in the next 2 slides in more detail, but I suppose this is the way you want the slide to look, with gross and net outperformance 1 year, 3 year, 5 years, and inception to date. And just to kind of recap, inception to date, it was January 1, 2014. So that's 7 years. And our track record is GIPS verified. One of the questions that's popped up has to do with auditing ESG compliance or performance. I think that question really relates to the ESG component of performance, but in terms of the financial component of performance, a GIPS audit is sort of the highest standard of veracity in performance reporting, and we are audited by ACA Compliance Group. Kyle, you want to jump? Yeah. Okay. So even though we've outperformed over 1, 3, 5 in inception, that doesn't mean we outperform every quarter. So what you notice is that this is based on the first 2 columns, or the first column is based on Q4 2020, where we actually underperformed after a pretty strong Q3 and a very strong Q1 on a relative basis. And so year to date, we overperformed the S&P, but again, it doesn't always mean that you're going to outperform in every individual reporting period. I think that the next slide actually provides some more useful data and sort of covers a few of the points that have already been made. But I would point to annualized return, which is 200 basis points gross better than the S&P 500, substantially better than the S&P value. Alpha at 3.85% gross, and also a down capture of under 68% gross, which essentially means that on average, when the market goes down, we're only participating in slightly more than 2/3 of that down cycle, which actually has been a very important driver of overall performance for us. Kyle, back to you.
Thanks, Bill. Just to go into some of the Q4 commentary. Q4 was not as good as Q1 or Q2. In Q1, we outperformed by around 4%. Q3, we also outperformed, excuse me. From a selection standpoint, we did not do as well. Around 48% of our names outperformed versus 59%. In terms of absolute contributions, Hilton, MSCI, Garmin, Waters, and IDEX were probably the 5 biggest drivers, representing around 1/3 of our performance. The one thing I'll call out is we think we did a good job on the risk management front, in the sense that our drawdown was lower, our beta was less than 1, so we did well there, while obviously we did not do as well in terms of our hit rate. I'm going to speak about the year end for 2020. I know there are some questions, and we'll start to get into them as they, if they're on the material being shown or not at the end. First and foremost, I think if you look at the market environment in 2020, we think it was a bit of a challenging year for stock picking. If you had sat on Jan 1 and just picked stocks at random, only 31% of them would have outperformed in a total return, 41% of them on a risk-adjusted basis, and 31% of them on both a risk-adjusted and total return basis. One of the big things to think about is we view ourselves as systematic. So if we wanted to assess how our system did, if we were to pick names on the start of every quarter and see if we did better or not, and we did the same with the S&P, we only really did 0.5% better than the S&P in being able to pick names. If we look at the other half of our system, and I'm going to go into the details behind these after in the following slides. If we look at it from a risk management standpoint, the S&P had massive, huge volatility and big losses in Q1, ending the quarter with minus 19.6. That was the S&P, not us. We think not losing money is our best way to outperform, at least in 2020. That's our opinion, as recovering from losses take a lot more than having to make back gains. First and foremost, our risk model allowed us to have a lower beta. than if we'd allocated equal weight. We're actually going to show you later on the two versions of the portfolio. One was what we ran, and the second one is an equal weight, meaning if we did not apply our risk controls, how things would have been. Before I jump there, I wanted to address something in that we try to avoid concentration in the large names from not only a diversification standpoint, but also risk. In the S&P 500, if you look at the total return of 18.4 in the S&P for the entire year of 2020, Apple is almost 4% of that. So Apple is a big one, and so is Amazon, Microsoft, Google, and Facebook. We did not have any of them except for Facebook in Q4. In terms of what was our rate in having some of the top contributors of the S&P, you'll see that of the top 5 names, we only had one of them in terms of one quarter for Facebook, 4 of the top 10, and then 12 of the top 20. This does not mean we had 12 of the top 20 names, but rather 12 quarter name occurrences. Looking at stock selection by quarter, if in Q1 we actually picked the names quite well, both from a total return and risk adjusted standpoint. Q2 as the market rebounded and went straight up, our low beta or selecting names that tend to be a bit more focused on risk went a bit against us, in the sense that those names did not outperform as well, even though on a risk adjusted basis they did. And if you look at the names that had both properties, we tended to pick them a bit more in Q2. Q3, we tended to stock pick very well. If you look at our combined hit rate of picking names that outperformed on both bases against random, it was around 14% more. And in Q4, we did not, from a picking standpoint, we did not do well on either both total return or risk adjusted. There was a question as to why was the hit rate lower. One of the things is you can't win every time, and our model tends to pick names that are a bit more defensive. And in Q4, a lot of the returns came from larger names that were a bit more offensive. So this is our hypothesis, is that the kind of core factors that are driving our model didn't allow us to pick the right names. I'm going to pivot on to risk management. The red line, as you see at the bottom, would be our portfolio if we did not apply our risk optimization process. It would have suffered a very large loss in Q1 that it would not have recovered from on a relative basis against the S&P, and we would have ended the year underperforming. We did fortunately apply our risk optimization process, which allowed us to outperform and avoid that large drawdown. So we kind of use this to ask ourselves the question, going back to it, is, are we picking the right names and are we choosing the weights correctly? To kind of go a bit more into depth on this is, in Q1, we had a better max drawdown. That means we lost less at the worst point evaluated daily. So this is a bit different than some of the statistics you'll see on our fact sheets and other materials that are composed monthly. And this is based off a frictionless simulation in order to kind of have some consistency. You'll see that 3 out of the 4 quarters, except for Q2 when the market effectively went straight up, we drew down less than the S&P, which to us is a big thing. We have the equal weight one just to show that's a riskier version. And then I'm gonna just briefly touch some risk metrics before we get into Q&A. Is one, from a volatility standpoint, Q1 we had significantly less volatility than the S&P, around 6%. We had a lower beta too, and a lower downside deviation. The quarter where we really had, I would say, worse risk properties was the one quarter where the market rebounded sharply after the large drawdown. So looking at these numbers, it might look that we were quite far worse, but the market environment that this happened was more of a rebound or a straight up environment. And overall, we had a lower volatility than the S&P, and we had a lower beta and a lower downside deviation, which is kind of the parts that our risk management process is designed to go after. I'm gonna hand it over to Bill as we start to address some of the questions asked.
All right. I saw three questions, and I've answered them. I'm not sure if everybody can see the questions and the answers, but I've got a couple of new questions that have popped in. One is, where are you available? I think I mentioned that, but we're currently available on Schwab. We also do a little bit of work on Fidelity and TD Ameritrade, but I would say Schwab is the primary custodian for relationships that we manage directly, and then for sub-advised relationships, it's on a bunch of different platforms: Fidelity, TD, Natixis, Envestnet, SEI, etc. Another question that came in is, how dynamic are the ESG factors? I asked because of COVID, BLM, et cetera, how do those factor in? So that's a really interesting couple of questions. I would say that I would answer it by saying that we have always viewed ESG as necessarily dynamic. And by that, I mean that as big companies lean into businesses to get them to be more transparent, the effect of that is that companies are now sharing additional information. So 3 years ago, one of our key performance indicators was air emissions. Now that has been broken down into NOx, SOx, FOX, and particulate matter. And it's simply because companies are disclosing the data, and we're now able to compare those companies. And that will continue. And similarly, or maybe said differently, I think 4 years ago, we had 10 key performance indicators. Now we have 21. I would imagine the number is just going to keep going up every few years. The COVID question is a really interesting one, because one of the things our portfolio team did in April or May of this past year was we sat down and we said, listen, our performance relative to the market was very good, but there's a material risk factor around an issue called paid sick leave, which we had never really thought about. I don't think very many portfolio managers view paid sick leave as a risk factor to performance. And in certain industry groups, and even through COVID, it isn't, but there are industry groups where you tend to have lower paid workers working in industrial settings. And if they don't have paid sick leave, they're going to work through a pandemic, and then the plant's going to get shut, and it's going to affect quarterly performance, which is going to affect investor performance. And so we began to think, how do we get a handle on this? We actually did, together with Corporate Knights, which is our primary ESG research provider, we did a webinar this summer and preceded it with a big research effort to determine really what the practices were in the within the S&P 500 and within some of the largest companies in the world. And we actually have developed some information which we plan to incorporate as material risk factors moving forward in certain industries. So hopefully that answers that question. And let's see, are there any others?
Can you see the next two, Bill?
No.
We have one that that wants to. I'm going to synopsize for you to make up a word. Michelle Urban's question on Japanese usage required. It's not really a question. I guess it's more what's the difference between our feed and Sustainalytics and MSCI? Sorry, Michelle, I'm extracting a question from your statement. Bill, you want to grab that one, or do you want me to?
No, I can grab it. Look, there's a lot of firms out there that provide ESG raw data and scoring data. We ultimately selected a firm based in Toronto called Corporate Knights Research. We selected them because we noticed that they had a rules-based and therefore unemotional approach to ranking and scoring companies. And we thought that that was important, partly because we were building a quantitatively driven product, and it just didn't make sense to have a quant product where a third or a half of portfolio construction is sort of driven by human emotion. So we sort of like the lack of emotion in their approach. Corporate Knights has been doing this actually for a long time. They publish something called the Global 100 for Sustainability, which is published or announced at Davos every year. It's been picked up by Thomson Reuters and I think Fortune magazine. And we happen to like their approach and their data gathering processes, and we partnered with them. And I think we might have been the first investment management firm that actually repurposed the data that they were creating specifically for portfolio construction. That said, I recognize that most of the industry does use MSCI, Sustainalytics, or another firm. I think that, my belief is that a lot of the data is getting commoditized. If Caterpillar or some S&P 500 company announces that they've set climate-based targets and they're going to be, zero carbon emissions by 2050, it doesn't take very long for all of the firms to actually gather this data. So I think it's more what you do with the data than anything else. Michelle actually is pointing out also the staleness, rearview mirror nature of these ratings. And I fully agree with that, because almost all ratings are derived from corporate sustainability report filings, which are often, a year to a year and a half old by the time they're published. What we do to sort of combat that dynamic is we actually also take data feeds from probably 20 different NGOs that tend to be issue specific, and then also tend to be much more sort of current in their point of view. And so imagine Global Canopy Initiative that looks at palm oil deforestation and publishes reports annually. We basically take those reports, we codify the information that is in them, and we use them to create point deductions in our scoring methodologies. So we do have an approach to actually, add real-time data to the data that we're basically amassing through Corporate Knights. One question is, what are your current assets, and at what level would you consider adding a person in what area of expertise? Our current assets are about 130 million, which is about more than double what they were at the beginning of 2020. I would say we, are always thinking about the types of positions that we're going to add next. We just added a part-time analyst. I think that probably the next position we're going to probably add would be an ops compliance person. Right now, we used an outsourced compliance firm in addition to the outsourced, obviously the GIPS audit firm. Let's see, two other questions. Are there common characteristics in portfolio construction across the ESG universe? Kyle is actually going to answer this right now. Before he does, I'm going to answer another question, which is what's the capacity of the product? Our best guess is that it's, north of 10 billion, maybe as much as 20 billion. I mean, we are investing in the largest, most liquid companies in the US within this product. Obviously, there's other products that we can and probably will create down the road that might be more all cap or even small cap, where capacity would be a bigger issue. Kyle, do you want to tackle the?
Yep. In terms of Rich's question, which are there common characteristics in portfolio construction across the ESG universe, and kind of characterize and explain how our construction differs in terms of risk factors and correlation. First and foremost, I would say our process does not involve us trying to buy or go long certain factor exposures. We treat our process as I would say this is a bit different in that we view ourselves as one stock pickers who weight stocks based on risk. And when I say risk, I don't mean ESG or fundamental factors. How we weight our stocks is generally based off the relationships of the stocks to each other. So more from a diversification and drawdown standpoint than necessarily a factor-based way. How we pick the stocks I'd say there are things that we use that everybody else uses. So if you look at our ESG screen, board diversity is in there, clean revenues in there. So we do have, I'd say there's some very common things. And then if you look at our fundamental side, we do have valuation ratios that everybody else has. But the way we use them is not necessarily how a traditional factor quants would say, I want to be long value or I want to be long momentum. We use them saying, does momentum or value give our model the ability to discriminate between the outperformers and the not outperformers? And then we got one final one with Facebook Bill on the ESG space. Do you want to grab that one, or do you want me to grab that one?
No, I can grab it. So it's a really good question because, fundamentally the question broader than just kind of zooming out from Facebook is, if a company is removed from the portfolio or not eligible to be in the portfolio from an ESG standpoint, how does it work its way back into good graces, I think. And Facebook is a great example because in the fall of 2016, I believe it was, when the Cambridge Analytica thing broke, we actually removed, Facebook was in the portfolio at the time. As Kyle mentioned earlier, we have never been sort of overweight FANG or even equal weight FANG. We've always kind of treated it very delicately, and just from a quant standpoint, that's the way it worked out. We've just never had a lot of it, but it did happen to be in the portfolio. It took a little time to kind of unpack everything that was going on there, but ultimately we made the decision to manually remove the position from the portfolio. It's only the second time in 7 years we've done so. The first was Wells Fargo. And in removing it from the portfolio, there's nothing that would prevent it coming back in. I mean, there are companies that we own that I scratch my head sometimes and I say, I don't really love that company or I don't love that industry, but we have always been very careful to not let emotion kind of interfere with, the process that we built around portfolio construction and why we would buy something and why we would sell it. Facebook happens to be one of those companies that, personally I wish didn't exist, but leaving that aside, I was a little surprised that Facebook came back into the portfolio in Q4. And in terms of it going forward, even though I think that, there's a lot of challenges with Facebook, the reality is that we followed the rules and the quantitative scoring that would allow them to be in the portfolio. And keep in mind that the way we operate is, I hate to use this expression, but we will take the top 50% of an industry group, even if the companies in the top 50% relative to other industry groups don't get great ESG scores. So again, our thesis is that we want to expose our investors to as much of the economy as possible, and therefore we're going to invest in the best companies in each segment of the economy, but that doesn't always mean, that we would expect ourselves or even our clients to be wildly enthusiastic about their participation. So Facebook is in the portfolio. It will leave the portfolio when it either fails the ESG screen again, or when it fails the fundamental screen, or when it fails the optimizer. One more just came in. With companies in every industry group beginning to adopt social purpose as a part of their competitive strategies, is there a risk that ESG screens will be less impactful over time? I think on the face of it, yes. However, I also think that over time, additional, like once you start disclosing, once the company starts disclosing information, the tendency is for there to be more questions about that information and to ultimately lead to further disclosure. So the reality is, I think that there is always going to be an edge that can be gained by analyzing the data as it becomes available. And there's no question that more and more companies are going to just start to disclose more and more. And I think that there's absolutely no question that more and more asset managers are going to incorporate ESG to the point where 5 years from now, I believe this is all table stakes. We won't even be talking about ESG. We'll simply be talking about maybe more thematic variations of ESG for investors. Last question, any news or plans for 2021? Kyle, do you want to take that?
Sure. We actually have quite a fair bit in the pipeline. There's some tasks that we have going on from a data front where we're trying to source more data, not only from an ESG standpoint, but from a fundamental standpoint to see if we can extract insights that others might not be able to get to so easily. There's some improvements that we have to both our optimization framework and our security selection framework that we hope will show up in the 2021 and future performance. Overall, we are, as Bill said, we have been named the large cap core manager on an ETF, and we hope to also potentially launch new product this year beyond that in not the large cap core space.
And we took over the portfolio management of a global ESG strategy that also has a 5-year track record in Q4 of 2020, and we're in the process of incorporating that into our marketing materials. And we will begin to actually market that product, which has a very good track record as well. Question from Nick on maximum AUM you want to limit yourself to. I would say that we didn't start Stance to say, look, we want to get to 20 billion. What we said was, we believe that there is something that isn't being done in the marketplace, and that is building product in a way that allows clients to align capital with values without underperforming the market. And the contribution that I think that we want to make to this industry is to help as many investors as possible understand this, because investors do have weight to them. You know, people may think, well, I only have $500,000. What difference does that make? Well, the reality is, if 20 million people with $500,000 start to vote their proxies in a certain way, it's going to affect the way boards and management teams run companies. And that's I think the point of all of this. So I would say we don't have a specific AUM target. We would like to be big enough to impact the world around us. And my guess is that's in the, many billions of dollars, but we don't have a specific target. And the last question that I see right now is, what advocacy work does Stance do to actually take their ESG companies to task? So as a quant manager that doesn't believe in necessarily buying and holding a company for a long period of time unless there are ongoing reasons to do so, it's a little difficult to build a advocacy practice, because that is best managed by actual shareholders of companies. Our philosophy is to selectively get involved in advocacy. So an example of that is Stance Capital is a lead engagement firm together with Breckenridge Capital on an initiative called Climate Action 100+, which is an effort between Ceres and the UNPRI to bring together the world's largest investors to lean into the world's largest carbon emitters, to get them to agree to emit less carbon, or ideally actually to get to kind of zero Scope 3 carbon by 2050 or earlier. And so Stance is working together with Breckenridge and a team of global investors, probably 10 investors from around the world. And we are focused on Caterpillar, a company I mentioned earlier, which is actually a target company of the Climate Action 100+. And just very briefly on that, CA 100+ is an initiative that was inspired by the Treasurer of California, who noticed in doing research that just 100 companies globally have been responsible for something like 75% of all industrial carbon emissions since 1985, which is really sort of an extraordinary thing. And while many of those companies none of us have ever heard of because they're buried in India or China or some faraway part of the world, the reality is there's probably 5 or 6 of them that are in most people's Vanguard passive, index fund sitting in their 401k plan or their IRA. So the fact of the matter is there's a bunch of US companies that are target companies within climate 100 plus. CAT is one, and we are doing engagement work. We're actually leading engagement work with Caterpillar. And I see that we are out of questions. We are at 45 minutes, and we have taken a lot of your valuable time today. So I thank you for joining us, and we will do this again a quarter from now.
Thank you very much, everybody.